Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, Paul Winkler, talking money and investing. Okay, so I get this question all the time. I was on News Channel 5 on the open line, and this question came in there. It comes in all the time. I'm actually being asked to speak at something on this and related topics in a couple months. I was asked to come talk to a group, and this is the topic. So I figure if a lot of people are asking this question, it's still out there. So I want to talk about this. Gold. People still asking about investing in gold. And, for those of you that don't know my position on this really quickly, it's not an investment. They'll tell you it's an investment. You have a gold IRA. You can do that all day long. It's not an investment because there's no cost of capital. There's nobody paying to use your money. Therefore, to try to determine what it's worth is like, whatever. I had this little segment that I did a while back where I played a little piece from CNBC where this guy's going, hey, the 4,500-year return to gold is zero after inflation. You may remember me doing that if you listen to the show on a frequent basis. 4,500-year return of gold, yes, I'm going to repeat it, was zero after inflation. You could buy the same amount of goods today that ancient Egyptians could buy. So, go figure. It's not really great investment, but it's sold and there's a lot of money to be made trying to sell you on it. But listen to how this is sold out there. And this is, I feel sorry for this couple because they're really, they're not identified. So I guess I shouldn't feel bad about playing this. But let me just play this.
Christy and I are both in technology and have been our entire careers. Tech moves fast. And there's a philosophy and a cadence with respect to the people that are employed in tech with regards to their investing, their career trajectories, and just the overall kind of cadence.
Okay, so number one, they're in technology. And I just got a text from Shane. He says he can't believe he's listening to this indoctrination. He's so funny. But so you listen to this couple, they're in technology. What they're saying is actually this makes a little bit of sense. That they're in technology, they don't want to have their retirement too much in technology. And there's a point to be made, but this is something I've talked about, that you don't want to have funds that are overly concentrated in technology stocks. But the problem is most 401k plans are overly concentrated in technology. So they have a point at the beginning of this particular commercial regarding their concentration in technology in both their workplace. This is, by the way, one of the reasons that ESOPs can be problematic, employee stock ownership plans. You have stock in your company that you're buying, and all of a sudden your job has problems, and you end up in a situation where you have an issue with your job going away because the company is struggling, and your retirement goes away. So, hey, that's an issue. That's a huge issue. But that doesn't mean you have to invest that way, because technology is only going to be really super, super concentrated in the high end of the market right now in very, very large companies. Okay. So in essence, they have a good point, but it's just kind of not being applied very well.
And so what life's like working in tech. One of the things that Christy and I wanted to do was find a mechanism outside of that cadence.
Because what's really important to me is diversification. And I want to make sure.
It's my favorite word to hate. I get this all the time, when I'm doing interviews, and they'll say, so Paul, you're talking about diversification. I'm going, yeah, no, not the way you think about it. Owning a lot of things. I could be diversified and invest in shoes. It's not going to help my retirement plan a whole lot. I could be diversified and invest in Beanie Babies or, whatever. The reality of it is you can own a lot of stuff, but it doesn't make you diversified in the way that an academic would call diversification. An academic's going to be looking at how things move in dissimilar fashion. Like, for example, investing in mid-cap stocks. You hear about that all the time, but that's not a good diversifier because it moves too much with other areas of the market. So when I'm investing in, I could be investing in commodities. I could be investing in, commodity. That was the big thing that Fidelity tried to sell in the mid 2000s. Oh, we got this commodities fund. And as a matter of fact, a lot of people did that, not just Fidelity. I mean, that was rampant in the industry, pushing commodities investments. And they just went crashing down after 2008, 2009. They came crashing, crumbling down. So diversification isn't always a good thing, but that's what she's saying. We wanted to be diversified.
Or that no matter what happens in the market and the economy, that we are just diversified.
No matter what happens, this thing is going to go up in value is what she's implying here. There's a big problem. There have been many periods in history where these commodities and investments move right with the stock market. So that goes against diversification. They're moving together. Diversification is helping you protect you against those downsides. But if this stuff moves with the market down, you got a problem.
And so I wanted to make sure that gold or something that was outside of the normal norms was something that we focused on.
Call to get your free copy of my new special.
So this guy's going to push it and blah, 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 blah.
On how
I'm
you
just
can
gonna push
begin
it forward.
Sophisticated investors that spend.
Okay, now I want you to hear this.
Physical gold, silver, platinum, and palladium.
Look,
And as I always like to say, if this stuff is so great, why does this guy want to take your dollars for their silver, gold, palladium, platinum, and all that kind
I'm
of
not going to pretend as though we are the most sophisticated investors that spend hours and hours dissecting the market to understand what's happening next.
And that's just it. Too many people just blindly trust that they know what's going to, that the advisor that they're working with or whoever's selling them something knows what they're doing. And the reality of it is, a lot of times the advisors aren't that well educated. I'm going to tell you, I came from that side of the industry, working for huge investment firms. And I'm here to tell you that the level of sophistication was non-existent. It really was. And it's shocking how little sophistication. No, so he's saying, I'm not going to pretend that we're sophisticated. But listen to what he says next.
But we know enough and have read enough to understand the trajectory of precious metals as a...
What? I'm not the most sophisticated person in the world, but we've read enough to know the trajectory. You know where it's going? That sounds like it's fairly sophisticated to me for you to know the trajectory of these metals. And what were you reading? Where was the material coming from? Was it a sales brochure? Probably. Or was it written by maybe an article written by somebody that's in the business selling? Because a lot of people get information from people that are selling things and they just don't even realize it.
A financial instrument based off of what we've looked at and what we've discussed with each other. We saw it as being a steadying element of our overall portfolio strategy.
And it doesn't steady. That's the problem. The correlation is non-existent with inflation. And the correlation is extremely low. You don't have any real correlation relationship. Its correlation is where things move together or move separately from each other. If I have a positive one correlation, that means two things always move together with each other. If I have a negative one correlation, they always move opposite. If I have no correlation, it's random. And that's the problem you've got here. It's random. You're adding something to the investment portfolio, at least if I'm going to add something, because remember I said that gold has no return after inflation. So you look back through history, that's the 4,500-year number that I was talking about earlier. No return after inflation, according to the guy in CNBC was talking about that. Now, here's the thing. What else doesn't have any return after inflation? Treasury bills. Okay, so Treasury bills historically have a return of about zero. It's like 0.4 after inflation. But why would we use that as opposed to gold? The reason would be that when you have stock market downturns, at least treasuries hold their value. They don't go and move with stocks because they hold their value. Because what is it? It's basically issued by the government that can print and tax. So we have this difference in how these things operate. That is a far better diversifier than gold. You know, if you want something that doesn't have any return after inflation. Now, why do people get the impression that it has a return after inflation? Because it can have big run-ups in value over short periods of time. And then people actually, because we have a tendency as humans, we look for patterns. We're pattern seeking. That's just who we are. And what we do is we look at this pattern and go, oh, this thing's been going up. I think it's going to continue to go up. And we make that mistake again and again and again. People have made that mistake all through history. Nothing is different now. But if you become a more
This is
educated
Paul Winkler.
investor,
Hope you enjoyed
you don't
today's
fall
edition
for it.
of the Investor
That's
Coaching
my
Show.
goal. I'm Paul
If you
Winkler.
want to learn more
Listening
about
to the
what we
Investor
do,
Coaching
go
Show
to
right
our
here at
website,
SuperTalk
paulwinkler.com.
99.7
Until
Be back
next
right
time,
after
I'm
this.
Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.